Most investors chase returns. Smart investors chase consistency. So in this video, I'm going to break down how accredited investors earn predictable passive income using real estate-backed lending strategies. Predictability, it matters a lot, and consistency matters significantly. I attended the University of Nebraska at Omaha, and so every day while I was a student there, I drove by Warren Buffett's personal house. He just lives 3 blocks from the university. And if you want to talk about what consistency looks like, he's probably the greatest standard. Something like 90+% of that man's wealth was generated after he turned 65. Consistent, steady, day in, day out, year in, year out, steady returns. And letting it do its things, it compounded significantly over the course of that man's lifetime. And it does the same for all of us as investors. It requires being consistent and doing it day in and day out. Predictability matters most. Volatility can kill planning, especially if you're aging to it, or really meaning getting to a spot where you're going to retire or planning to retire. Volatility can kill that planning, because if you look at the stock market, it's done really well over a period of time, right? Consistently up over a period of time, extended periods of time. But within that, each and every year, there can be significant changes, right? Up 25% one year, down 25% one year. And that that uniqueness provides a challenging perspective when it comes to planning. Real estate-backed lending doesn't have that. It's typically very consistent over a period of time. It's because one is lending money to an investor, to a project, typically the way we structure them on short-term basis. So the predictability is cool. You're going to pay us each and every month until that thing's paid off in 4 months, 6 months, 12 months, whatever that short time frame happens to be. Real estate-backed lending works when done really, really well. For us, that means lending in first position only. Don't want to be in second spot. Too much risk in that position. It's first position only, and it's conservative underwriting. It's underwriting first the project. What is the piece of property? What is the project? Understanding that at a deep level to understand that it's actually an opportunity. There's actually a real deal there. And then second, the operator. Who's doing the thing? Because if the first one doesn't line up, if it's not an opportunity, if it's not really truly an investment opportunity, who's doing it really for us, doesn't matter. So that's why it comes second. Who's doing it? What's your track record? What's their background? What's their experience? What's their credit score? What's their liquidity position? Can they see this thing over the finish line? Debt versus equity for passive investors. On the debt side, it's cash flow. It's predictability. It's getting the money month in, month out as investors are paying that debt, that bill that comes due every month. Equity side, it looks a little different. It's largely about appreciation and betting on the upside, betting that, for example, the operator's going to be able to execute and you're going to get rewarded in 2, 3, 4 years when that thing repositions. On the debt side, it's can they execute in 6 to 12 months and reposition that either for sale or to go refinance us out, independent of what they're doing on the equity side of things. And then markets matter. Where are you investing on the debt side? So here in the Midwest, it's largely conservative. Things don't move like they move in the coast. Things are much quieter, much simpler. And that we're in a market, Des Moines, Iowa, in a market where we can continue to see population growth, which means that if somebody's going to flip a property, for example, and it doesn't line up with their numbers when it comes to exit, they can always rent the property because we've got consistent rental growth year in and year out. So understanding that multiple exit strategy and understanding what markets look like versus having to be speculative. So if predictable cash flow matters more than flashy returns, well, this strategy is worth understanding. If you want to learn more and want to understand how we do these things, I dropped a link below in the description. You can watch a video there.